Hello everyone, this is Avijay Chatterjee recording a weekly session of Chartsarefun. This is for the week of January 19th, recording this in the afternoon of January 25th. Today we're going to look at the precious metals. In particular, silver has been hugely outperforming gold. So we'll look at the silver to gold ratio. We'll look at past moments where the silver to gold ratio has shot up, and those happen to be in the prior two big peaks, macro multi-year peaks in silver back in 2011 and before that in 1980. These things don't happen every so often. They take over multi-years for that kind of parabolic and ballistic peaks, as Barron calls it. So we'll look at the prior to periods when this happened, 2011 and 1980, compare what happened to gold, what happened to silver, and the S&P 500, and then contrast to what could we be setting up now. Silver shot up huge last week. It crossed over 100. Gold is at the heels of crossing 5,000, two key psychological big levels. And we'll see what S&P 500. We know that this is the week of big tech earnings. A lot of the Magnificent Seven will be announcing earnings. Microsoft, I think, is on Wednesday. Tesla is on Wednesday. So Alphabet, Apple, I think some of the key big hitters will be announcing earnings this week. So we shall see what is the S&P 500 and the QQQ telling us. So with that, let's go straight into our blog site, chartsarefun.substack.com. We appreciate you subscribing to our blogs. As soon as they come out in the mornings, it'll be emailed out to you. Our YouTube site is also Chartsarefun. We do believe tremendous insights in charts. That's what our goal is, to share why these are absolutely fun patterns, fun insights. And if you subscribe to our channel and like the videos, we really appreciate you hitting the like button. So I trucked right into Barron's, and right in this weekend's Barron's, they have said that silver has gone ballistic. How to play the move? Barron's, of course, expressed bearish sentiments about silver having moved up as much as it has. You can see the two colored charts, the black in silver, the gold in gold, and we can see just over the last little more than a year, it started off from January of 2025, how much has silver moved? In particular, you see that they were climbing up together till the last maybe 4 months or so, where silver has absolutely shot up. And now that right into the ratio of gold to silver, this is a historic ratio, that right now has dropped to like a sudden drop, more than half, from 100, which was like towards sometime in early 2025, it's now near 46. Where do we see similar kind of drops? Well, that happened in 2009 to 2011. From 79, it got cut more than half and fell to 32. And then in 1979 to 1980, from 38, it got cut again in more than half to 16. So same thing, cut more than half from 100 to 48 right now. And we shall see what happened in these two prior periods when that ratio dropped that significantly, so as in 2011 and then in 1980. So we'll go straight into 1980, and we'll start off with the chart of gold, and we can see that the particular climb, you can see the huge climb, the rate of climb, especially how much it has diverged from its 200 period moving average, was over 200 and almost 250% above its 200 period moving average was what gold did. And you can see that sharp climb, that sharp ballistic parabolic climb in the this is a weekly chart, by the way. So from December, it took off, and by mid-January, it had climbed from 426 to 835. Literally almost a double happened in a span of 6 weeks or so. So that's what gold did back then. You can see MACD shot up, and you can see the deviation from the 200 period moving average shot up from somewhere in the 55 or so percent to all the way to 250%. That's how sharply that, or from, in fact, this is right around 100. So 100 to 250 is how much it climbed in the span of December to mid-January. So we can see the extreme RSI. Similar thing happened in silver in 1980. You can also see its vertical climb. It shot up even more than gold. So that's why the relative ratio of the gold to silver fell that much. You can see that silver shot up above its 200 period moving average by over 450% or so. That was its climb. And you can see, again, very extreme overbought in RSI when that happened, very sharp vertical climb happening in there. And then look at the drops in each. That's what we are cautioning. Today's the key message is watch out when these things drop. When you have vertical climbs, it's like you go up the elevator really, really fast, and then you come down, it comes down just as fast. Especially vertical climbs like these don't end very well. And we can see it drop, right? From 49, it fell to 10. That's the kind of drop silver got. And look at the drop in gold. From 835, it fell to 480, all happening in a span of 2 months, from mid-January to mid-March. That had happened. Same thing with silver, from mid-January to its initial drop by mid-March had already fallen from 49 to 13, slightly climbed, and then by the time it tested its 200 period moving average, it fell all the way to 10. Those two happened to gold and silver. Look at what happened to S&P 500 in 1980. It topped not at the same time like silver and gold did. It topped a couple of weeks later, more towards mid-February. And from there, look at the drop, 120 to 97. That's just about little close to 20%, 19% or so drop in S&P 500. We can see that from there, it did climb up to higher highs and shot up always from 97 to almost 141. So that's close to like 44 points or so in S&P 500. And so that's almost like 40% or so climb that happened, a little more than 45% climb that happened in S&P 500 in that period. But there was a drop in S&P 500 when the precious metals fell. It's just that the S&P 500's drop or top triggered a few weeks after gold and silver did. Now, the next ratio, if you looked at the ratio, the next big drop in that ratio of the gold to silver happened in 2011. 1980 was this one, which we talked about. Now 2011. If you look at that time frame in the gold to silver, this is our 2011 from 2009 to, this is a 3-year chart, weekly chart, 2009, 10 into 11. And we can see that around August or so, gold topped out. You can see again, extreme climb of the gold. You can see that this is from its weekly chart, what we're looking at. And from a weekly chart, we can see that the percent move shot up from above its 200 period moving average by almost close to 60% or so is what gold did. And from there, look at the drop. From 1900, it fell to 1500. Pretty fast in a span of, again, just 2 months or so, from August till close September, in a month or so, actually, 1920, because this is weekly. So these are 4 candles, means 4 weeks, a month of trading. It fell from 1920 to 1534. That's the kind of sharp drop that happened in 2011. If you look at silver in 2011, it had a rising channel that it broke down from. And when it broke down from, look at the week when the real drop happened. Up from the top of the channel to the bottom of the channel happened in a span of 1 week. Similar kind of channel is setting up. It's much steeper though. I'll show it to you in what the silver chart is showing us near term, but similar kind of channel is forming. But from that extreme overbought level of RSI and MACD, and you can see also the PPO, which is how far away from the 200 period moving average had silver climbed. At that time, it had climbed almost 150% above its 200 period moving average. And then look at the drop, and in a span of from April all the way towards September, it had dropped from 49 all the way to 26. So here, silver topped out ahead of gold. So we see that gold topped out more towards August into early September. Silver topped out here in actually in April, and from there it kept falling. Now S&P 500 in 2011 had an interesting pattern in terms of weakening signs with negative divergence in its RSI. All the way from early 2011, as it climbed higher high from 1300 to 1370, 1344 to 1370, RSI was at a weaker level. And then we can see that the drop happened around the same time when silver dropped. And then from there, it dropped all the way from 1370 to 1074. That's about 300 points, which is a little more than 24% or so. S&P 500 dropped in 2011. So now we are setting up for what we are seeing right now. And this is the latest chart, the weekly chart of silver. We can see a steep rising channel that silver has been climbing higher. RSI extremely overbought on that weekly chart at 87. Look at how extremely stretched MACD is. And look at the percent above its 200 period moving average, way higher than what we saw in 2011. So in 2011, silver had diverged to 150% or so above its 200 period moving average. Now it is over 205% above its 200 period moving average. That's how far stretched it is from its rising 200 period. That's how extreme overbought the RSI is. And look at this very steep channel. Once it peaks out, it's already at the top of the channel. It'll quickly come in and test its lower part of the channel, which we see now is rising, and it's a little over 90, between 90 and 95, around 92. So from 102 to 92, we can get a 10-point drop any day and then break below it. Especially when you have such vertical climbs, we would not be surprised to see silver come back. We can see that the 50 period moving average, the 50-week moving average is at 45. The previous peak before it pulled back and jumped higher is 54. So a test like getting a 50% haircut from 102, maybe it may go up, climb further to 110, down to 55, because that's where 54 and a half, 55 is. A 50% haircut could happen in the span of a month or 2 months is what we would caution. Extremely be cautious on what silver could do once it starts selling off. Gold, in a similar way, is rising up a channel, not as steep as silver. That's why the ratio of gold to silver has fallen that much. Silver way outperforming gold, but look at its channel. It's at the top of its channel. So if you look at from 2024, we draw this rising channel. It's been climbing up higher highs along the channel. That top of the channel was tested in kind of 2024, late October. Then again into after the during the tariff kind of situation, Liberation Day kind of situation, April to May is when it peaked. Then it tested the bottom of the channel, climbed up again towards October, late October, November, and then now it's back at the top end of the channel. So if that fails, it's already, we can see RSI is extremely overbought near 79, printing slightly lower highs from the previous peak, and we can see MACD stretched, and we can see how far it has diverged from its 200 period moving average. The highest so far in the last 4 years, it's right now at 83% above its 200 period moving average. So if gold pulls back, gold could also pull back to the low end of the channel, which we can see here is below 4,200. It's between 4,000 and 4,200, about 4,100. So from close to 5,000, it's likely going to test the 5,000 this week, because coming this close to a psychological level, it's unlikely. We saw that the high of this week was 49.89. So in the coming week, it could easily hit 5,000. But then from 5,000 pulling back towards 4,100, you're talking about easily close to 18% or so drop, which could happen very quickly in the span of a month or so. So be very careful with both silver and gold, knowing that they have known in the past, looking at 1980 and 2011, after they have those sharp climbs, to pull back very fast and in a very furious fashion. I'm going to end with a very interesting pattern from a technician, Tom Bowley. I appreciate and I listen to his blogs and subscribe to his Earnings Beats website. He highlights a very key interesting pattern called the put-call ratio, the equity put-call ratio, also called as CPCE. He's taking a long-term moving average of that, call it the 253-day moving average is what he's plotting out here. And he's saying that when this long-term moving average starts climbing, as in we now start seeing fear creep into the market, smart money start buying puts, and hence the put-call ratio starts climbing. Often it leads to either a flat market or it leads to sharp pullbacks. Look at when they climbed from 2020, late 2021 to 2022. That's when we got the last cyclical bear market. We got that 22 or 25% pullback, and look at that climb in CPCE. We just have turned around. CPCE has been dropping since that 2023 or so, and for the 2 consecutive years, it dropped to the point where late 2023, around October, November or so, it has started climbing. This is a change of momentum, call it a change of put buying, and a pattern where it's a harbinger for, as you can see, these red arrows are the points when the market outperforms. So it dropped here, it went up again in the 2018 to the 2020 timeframe, market dropped here. Here it kind of stayed flat as it climbed. S&P did not, range bound, did not do a big drop. Here, S&P dropped a few months later, but not to the extreme as we saw in this situation. We could be setting up for something very similar. This CPC long-term moving average as it climbs could easily get us a 20% correction in S&P 500. We got to watch out for. So with that, let's look at the rising channel in the S&P 500's weekly chart. This is also a fairly narrow and a steep channel that it already broke below. So we can see from the summer time frame, that steep channel, it was climbing along to higher highs till it hit 69.20, and then we got a sharp drop in the late October into the drop that we got from 69.20 to 65.21. From that drop, it broke below the channel. Since then, it's trying to hug the bottom end of that trend line, and RSI is printing lower highs. MACD, already we can see the histogram has gone below the zero center line, as is hovering right below the zeros. It's on the negative values of MACD histogram for now several months, last 2 months or so, it has been hovering below, getting ready to cross a lot lower. If a MACD drop happens, and we can compare that, by the way, to what happened in 2011, a very similar kind of situation. We can see MACD here also. Before the drop came, before the drop from 1370 to 1070, 300-point drop came in S&P, look at the early signs of MACD. MACD histogram had gone below the zero line. The signal line had gone below the red line. They were kind of diverging with negative divergence coming lower. And we can see from there, market topped out and dropped. Same thing with RSI. RSI had negative divergence, lower highs, and then the breakdown happened in S&P 500. We are setting up for something very similar. RSI is weakening. We can see this declining tops on the RSI. It has already dropped below its key rising channel and now hovering at the low end, getting ready to break down. And we can see that MACD is also pulled back quite a bit. So these are warning signs, very similar warning signs like 2011. In 2011, precious metals and both gold and silver peaked, and then S&P came down with it. So same thing, something for us to be watching into. So with that, let's look at a very short-term S&P 500 and QQQ from an hourly chart. And we know that said that this week is key Max 7 earnings, right? Several of them are going to be announcing earnings Wednesday with Microsoft and Tesla and maybe Alphabet, and then Apple on Thursday. 4 key Magnificent 7 stocks are announcing earnings. And we can see right here, the 50 period moving average on the hourly chart is on the S&P 500 is narrowing down. We can see that the MACD histogram is also narrowing down, getting ready for a cross below the center line. And look at the weakening in terms of the move, right? We are already peaked out at 69.86 on like 12th of January. From there, we had dropped quite a bit to a lower low from its previous 68.24 from the beginning of January to a 67.89. I've come back to test it, but then if we have any kinds of sell-off from these Magnificent 7 earnings, this could break down. And a breakdown from a 67.89 from a 69.86 takes us 200 points down back to the 65.80, 65.50 level, which is key support that S&P in the past has tested, as we can see here. So if you look at the S&P's chart, that 65.20 was the previous low that we saw in the late October, early November timeframe. And from there, we've already broken that trend line and kind of hovering and getting ready to break down. So that's something for us to watch. And the QQQ hourly chart is what even more bearish looking with respect to the 50 period, about to cross below the 200 period. And the 200 period is also kind of peaked out and now begin to kind of trend lower. We can see the 200 period was climbing early part of January. From there, it has kind of plateaued out and now beginning to come down. If the 50 goes below the 200, last time that happened in the December timeframe, 50 quickly hugged the 200 and then started climbing again. Bulls would say maybe that could happen again. I'm not saying that that's not possible. We still had put out a target last week of S&P potentially reaching 62.85. That's a target, and small caps IWM reaching 280. So small caps came close. It hit 271, but didn't quite get to 280. So there is some upside target-wise, technical target-wise, for S&P to hit 62.85 and small caps to hit 280, 280. Those two are still very much targets that could happen. In that case, good earnings could maybe give us a little more upside. But if we had to sum it up, what we are saying here is, as Barron has cautioned, look at what has happened to silver. And this kind of a huge parabolic line, got to be very careful with the metal's next move. And in particular, the ratio of the gold to silver, we can see in the past times it has dropped as much, has been typically like right around when the metals peaked out. So 1980, the same thing happened. 2011, the same thing happened. How do we know? Let's look at that chart. Look at how gold peaked out in 1980, beginning of 1980, and dropped from 835 down to 480 very, very quickly in a span of 2 months. Similar thing with silver, peaked out at 48 or 49 and dropped to 10, got cut literally from 49 to 10, like 75% or so, 80% or so drop happened in a span of just from in this case, January through May or so, in the span of 4 months. That's what happened to silver. S&P didn't do very well at that time either. In early 1980s, you can see that it dropped from 120 to 97, close to a little less than 19% or so is how much it dropped around that time frame. Gold back in the 2011 time frame, that's the next time the ratio had dropped a lot. You can see how gold topped out and pulled back. From 1920 to 1540, that's 400 points drop. So span of, in span of like 2 months or so, it dropped that quickly. Silver, if you look at its drop, it kind of was along a rising channel and then it broke, and then from 49 dropped to 26. So cut more than half, literally almost about a half, from 49 to 26 happened very like in the span of 4 months, from April all the way to September. First span of 5 months, it got cut around that fast. And then if you look at S&P 500 in 2011, it kind of topped out, gave us signals of the topping with the negative divergence in RSI and MACD. An identical pattern is shaping up now in S&P 500 as silver is climbing up in 2026 to its peak, top of its very steep channel, RSI extremely overbought, getting ripe for a sharp pullback. And we wouldn't be surprised for it to pull back towards 55. That's where we think the pullback to bring us to the previous peak before it pulled back and started climbing. So 100, 110 could be the peak in silver, and from there, a 50% haircut to 55 could pan out just this year. We've got to be very careful. Gold, in a similar way, is climbing along a rising channel, is close to 5,000, 49.89 or 49.89 was the peak on Friday. It could perhaps take out 5,000 being a psychological level that it'll probably scale, but then at the top end of its channel, would not be surprised to see it come back to the bottom of the channel, which around right now is around 4,100. So above 5,000, coming back to 4,900, 900 points, 900 points out of 5,000, you're talking about close to 19% or so, or rather 18% or so drop, which could come in a span of a few weeks to months. With that, also end with Tom Bowley's kind of caution. The put call ratio long term is beginning to climb. That's something that is typically whenever that put call ratio climbs, we start seeing drops. And these are the red arrows when the market tends underperforms. So the last big underperformance was 2022 through 2021 through 2023 or so. And around that time, we can see CPCE climbed. So VCPC is just about turned. As it dropped, the market shot up a lot. But as CPC now starts climbing, be very careful with some form of 20 to 25% pullback, very much possible. As we can see, the channel is already broken. It is showing negative divergence in RSI and S&P 500. MACD is already hovering at the center line, below the center line, the histogram getting ready for a sharper drop. Wouldn't be surprised for it to go from 69 to 65, 400, subtract from 65, 6100 is where we think it's very likely that we might see a pullback in the span of the next couple of months or so. So with that, the hourly charts are signaling some form of 50 going below the 200, some form of weakness. And if that drops and breaks below 67.89, 69.86 to 67.89 easily takes us back to the 6,500 level on that break on S&P. QQQ, if that breaks its 607 level from its peak near 630, you're talking about 23 points subtracted from 607. You're talking about close to 585 as a very sharp next drop if that break below 607 comes. Good luck investing. We'll talk to you next week. Be very careful with precious metals, staging its climb, start taking profits. And if you're aggressive, start looking at the ultra shorts on gold, which is at GLL, and ultra short, and silver, which is ZSL. Good luck investing. Thank you.